Well, first off, 107,000 is not a stupid number. If you take all the gold that the U.S. supposedly has and you divide that uh, into the debt and just the on-books debt, you end up with 135,000. So 107,000 is not crazy.
Yeah.
I have a little bit of a different take. 1913, when the Fed started, I don't really believe that you saw. I mean, you did see inflation of assets. You saw that in the 1920s.
Yes.
Then you had the crash in 1929 and the depression. The worst years were 1931, 1932, 33, when the banks were closing, and the government understood that they had to reflate the system. The only way to reflate the system was to revalue gold. And of course, what they did was they took the population's gold, marked it up, and that fixed the coffers of the U.S. Treasury.
The global financial order is entering a stage of reckoning that few fully understand. For over a century, debt expansion, fiat manipulation, and unchecked derivatives have created a structure so leveraged that even the slightest shock could bring it down. Gold, often dismissed as a relic, is quietly reasserting itself as the only honest benchmark of value. The numbers being discussed today, $107,000 to $135,000 per ounce, may sound extreme. Still, they're not irrational when viewed through the lens of debt-to-gold ratios and the historical precedent of monetary resets. Each major crisis, from 1933's gold confiscation to Nixon's closure of the gold window in 1971, followed the same logic. The system had to be reflated through gold revaluation. That moment may be upon us again. Bill Holter, a seasoned analyst renowned for his profound insights into debt markets and systemic risk, joins Francis Hunt, the renowned market strategist often referred to as the market sniper, to dissect the fragility of the Western financial system, the silent insolvency of banks, and the geopolitical realignment towards sound money. Gold will be the ultimate arbiter when trust in fiat evaporates, and the coming transition will be anything but smooth. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
What if this A, which goes right back to 1913, and the 80 high, you can call it 47 years if you take it from the Depression, but maybe if you take it all the way back in 1913, it's probably almost, 77 years to, no, 77 years to 80. And then we had the correction period, BC, as the 20-year financialization of everything after Volcker pushed the rates so high. He kind of cleared the deck, bought some space, 20 years of bear market, but that it's only a corrective in a five-wave move like that. Elliott wave is kind of like that. And its rule is the second up leg, which is the third leg, which is the CD leg, which would be from the 252 right the way up, is 161%. It's 61.8% bigger than whatever you took to be your first leg, which we're saying is the $20 fix in the Federal Reserve. You brought in the 70s, which is over here, where we clearly went very strongly. But I just wonder, am I going too far? Am I a moon boy now for thinking that since the financialization of the system could just have been that part one leg, and we had 20 years of pullback? Because this points to 107,000. But I think that's more a statement about the dollar than gold. What's your take? Just, I don't know if technicals or this thought process resonates for you.
Well, first off, 107,000 is not a stupid number. If you take all the gold that the U.S. supposedly has and you divide that into the debt and just the on-books debt, you end up with 135,000. So 107,000 is not crazy.
Yeah.
I have a little bit of a different take. 1913, when the Fed started, I don't really believe that you saw. I mean, you did see inflation of assets. You saw that in the 1920s.
Yes.
Then you had the crash in 1929 and the depression. The worst years were 1931, 1932, 33, when the banks were closing, And the government understood that they had to reflate the system. The only way to reflate the system was to revalue gold. And of course, what they did was they took the population's gold, marked it up, and that fixed the coffers of the U.S. Treasury. From that point forward, then we had World War II, which was very, very inflationary. The U.S. took on a ton of debt, and that was the cause, if you will, of Nixon going off the gold standard, because you had foreign nations, in particular France with de Gaulle, saying, here's $35, we want an ounce of gold. And they did that because they believed an ounce of gold was more valuable than $35, which, of course, they were correct.
Yeah.
So I think, I'm going to stick with 1971 as opposed to 1913.
Yeah. Yeah. Maybe they cleaned it up sufficiently that there was no carryover damage in the early 30s. Because it took them a while to first start creating the inflation and the over expenditure rule and all of that. Maybe that takes some time. But certainly, I'm not going to argue about 1970 being such a critical date. And many people will refer to 2020 in the future as a result of the CV19. I think that's still too fresh in our minds to see how historically significant it was. The end of that 40-year bond market that they managed to manufacture with when Volcker pushed the rates right up. And that's going to go, that was the pulling of America's bottomless credit card. I certainly think that's going to pop as a far more significant date when we put years between us in it. Because I also feel everybody, tell me if you feel this, Bill, everyone else feels like they're sleepwalking on the severity of what this means. Essentially, we're talking about the end of hegemony, but it's not even a friendly handover like the British to the US post World War II. It was kind of, you eased the baton out of the British hands and patted them on their head. There wasn't anyone getting beaten up about it. They obviously suffered and were the poor man of Europe for decades, paying the Marshall Plan and not having the hegemony currency anymore.
Right.
And that was a massive hit for them in a friendly way. This one isn't. It's a parallel system actively being built due to loss of faith in the original fiat-based system. And do you feel people truly are conceptually grasping the cost of living, the crisis that comes with the dollar and debt debasement? Because I don't.
Yeah, the handover is going to be extremely tumultuous. And I think the biggest problem is that when this happens, everyone in the West is going to absolutely disdain the United States because they'll understand that it was the dollar, that it was policies, it was U.S. policies that caused a disaster in the Western world. So from within the Western world, I think there's going to be hatred toward the U.S. And then outside of the Western world, you look at the BRICS nations. I hope this doesn't happen, but they have every right to shit on the United States, shit on the West, because it was our financial engineering that led up to and caused what's about to happen.
The one thing that isn't being discussed, I know Bank of America's put $500 billion into treasuries in 2020 before the 55% collapse. Why aren't we talking about the insolvency of the banks? Because the fact that that's quiet worries me more, that we could be very close to the great taking and it's about to explode. With everything that's already transpired, with the currency movements, the gold movements, you're referring to the silver above 50 movements and the derivatives, obviously, which we all know how much of the production is forward-sided, etc. Why aren't we hearing about that? And what do you think?
You're not hearing about it because they don't want you to hear about it yet. But you could go back to the early 2000s, Warren Buffett talking about derivatives and calling them weapons of mass financial destruction. He was absolutely right. And the derivatives market now is over $2 quadrillion. The problem with derivatives, with the type of volatility in the markets that we've seen already, and that we're obviously going to see bigger volatility going in the future, the problem with derivatives and volatility is it creates very big winners and very big losers. Now, you win and you start jumping up and down until you find out that your counterparty can't pay you.
Yeah.
Which means they've bankrupted and now they're not paying you. And because they didn't pay you, other counterparties won't do business with you because they're fearing that you're going to go out of business. And that's how the derivatives daisy chain collapses.
It's a Lehman's moment, isn't it?
Exactly.
Bringing roses. You know, the minute there's one bad apple in the batch, all apples could be bad. You know.
Yeah, with one difference: the Lehman moment, central banks and some banks were, and they had the ability to come in and save the system. Who's going to come in now? Who's the white knight going to be that comes in to save the central banks, to save the sovereign treasuries? There is none. Actually, there is one: gold.
Yeah.
If a central bank or treasury has gold on their balance sheet, that will be their savior.
Yeah, but they don't have enough of it, and they
at this price.
Yes, that's a good point, because that's why we were talking. I also saw a number. It was around 142. That if gold was revalued at 142,000, I think that dovetails with the 135, 136 you were talking about.
Right.
Effectively, America's zero. That means net.
Correct.
I mean, you're up, but your enemy
would
be very rich, and that's what many don't understand. Well, the Chinese, if they got revalued, everybody's gold gets revalued 142 or 135. We can argue about the number; it's not important. The problem is that just gets America to break even, doesn't it? Whilst other nations could potentially be a lot further forward.
Oh yeah, exactly. I mean, they revalue gold. What that does is it allows the United States to start over, and it allows, or it gives a push, it gives a head start to nations that were not, predominantly dollar based and had accumulated gold. They get the head start in the next race.
Silver's long-term setup is converging toward a historic inflection point. The repeated rejections near the $45 to $50 range mark decades of suppressed potential, but this time, the underlying structure is different. Nations like India are entering the market with strategic intent, doubling silver imports as gold becomes too expensive. At the same time, India's deepening alignment with BRICS signals more than just trade diversification. It represents a shift in monetary allegiance. When both Russia and the US declare silver a strategic reserve within months of each other, it becomes clear that the metal's role is being redefined from a commodity to a form of collateral. The next phase could unfold quickly once silver breaches $50. Above that level, the paper market's credibility will face a stress test. Failure to deliver would expose how over-leveraged the system truly is. Fear, more than greed, will drive the next bull cycle as institutions and individuals scramble for tangible value in a credit-dependent world. Inflation, in this context, isn't about prices rising. It's about currency units expanding faster than real output. And in such an environment, sound money assets inevitably reprice higher against debt-based instruments. This structural shift is already underway, quietly yet decisively. Let's get back to the interview.
There has been rejection in the $50, $45 range. We're yet to see anything coming in so far. That is a long scale chart, so it does look a little closer to 50 than it is on a bigger time frame. But that is a key move. The Indians, we've successfully, I want to talk about the Indians on two levels. They're turning into big buyers of silver now that gold is expensive. And their government is now doing what China once did. And more importantly, Trump's conduct towards India has driven them closer and tighter. They were a bit fence-sitting into the hands of the BRICS nations and going all in on this. It's the new system. Your comment on some of that socio-politics, both the silver aspect and the Indians themselves and where they're ending up.
Well, yeah, obviously India is going to do what's best for India. And if they're getting pushed on by the United States, pushed on by Trump, they're going to end up in the arms of someone that's friendly to them. And in this case, it's China. As far as silver is concerned, India has doubled their imports. And what has happened over the last, I think it was 9 months ago, or maybe not even 9 months ago, where Russia announced that they'd be buying silver and considered it a strategic reserve. And then that motion was seconded by the Trump administration in July or August, designating silver as a strategic as a strategic reserve. So, India could probably just read the headlines and say, well, hey, wait a minute, we got Russia saying they're going to buy silver, we got the United States saying they're going to buy silver. Maybe we should buy silver.
Yeah.
Now going back to your cup and handle chart, it is without a doubt my opinion that over $50 we get a failure to deliver, because there will be complete blood in the water. And I guess the saying, there's no bull market like a gold bull market, and the reason being, it's not all greed. You have a lot of buyers that have fear. They're buying gold, they're buying silver, fearing that their fiat currency is going to collapse. They're going to be left with nothing. So I will just say this, that fear is a greater emotion than greed.
Yes, we learned that in trading.
Yeah. And one last comment going back to that cup and handle chart. I don't know if a failure to deliver pushes silver, blows it through $50, or whether I don't want to say normal move, but a non-tumultuous move through 50. We get a close over 50, and then you get the sharks coming in and create the failure to deliver. But one way or the other, $50, it's obviously an important number. 1980, 2011, here we are again. And the only question in my mind is whether the failure to deliver creates above $50 silver, or does above $50 silver create the failure to deliver. And inflation is not CPI. It's not how much stuff goes up in value. It's how much money supply is created.
Correct.
And we look at them too, and this is off the top of my head, I'm going to say it's grown long-term, in the 7 to 8% range. So you're going to have a 7 to 8% inflation rate, some years above it, some years below it, and primarily above that rate, because you also have to take into account the amount of debt that's been put into the system, because debt is buying power.
Yes.
I mean, without debt, you wouldn't have a real estate market at these levels. Without debt, or when I say debt, in this case, I should say without the use of leverage or margin, you would not have, 3%, 3.5% 10-year bonds. They're buying assets, they're buying stocks, they're buying bonds with the use of margin. Look at the margin debt now, with the use of derivatives. It's the financialization that's done this. It is a completely overblown bubble, and I think you have to go back. I mean, we're again at the point where Richard Russell said, you've got to inflate or you die.
Yeah. And inflating more ensures you definitely will die, but you might get to postpone it a little longer until you run out of runway.
Right.
Yeah. Yeah. And so it goes deeper. But the consequences of financial system, I just think the re-rating and it's very misleading out there on social media, because there's people talking about a dollar spike and various other uncontrolled narratives that are intentionally serving as kind of cope. People will queue up at the convenient lie line over the hard-hitting, painful truth queue. You and I know that. Well, they aren't man enough to do it. We saw it with CV19 and everything else. And there's a lot of cope narratives that will say, you're going to be, don't worry, everyone else is worse. We failed our mass test, but they got an even lower mark. They're a big idiot. It's sort of dispersion. It's this relativity. But America's the hegemon. They're the ones sending treasury bills and dollars the other way when they buy goods with IOUs on a grander scale. They rely on foreign support for their debt market. Japan doesn't. All of these various things. And I get frustrated because it sounds like I'm being hard on the country. I want people to prepare correctly for something much bigger than they realize is coming. And are we right? Or is there a way you saunter through this? You have a couple of bad years and then you're bouncing back.
No, this is absolutely systemic. I mean, you're talking about central banks, sovereign treasuries, literally upside down, insolvent. Look at the Federal Reserve. Look at the ECB, the BOJ, but look at the Federal Reserve. The Federal Reserve, I did the calculation, I think it was in 2021. And at that point, the Fed had $65 billion in actual equity, holding up the entire pyramid upside down. Now, since then, because interest rates rose, they lost several $100 billion, which means the Federal Reserve is technically insolvent.
Yeah.
I mean, that's an example. That's a perfect example right there. Once you get a lockup in credit, everything stops. Nothing runs. And when I say everything, forget about the markets. Forget about stocks, bonds, Bitcoin, everything. Forget about all that. The real economy stops because the real economy no longer runs without credit. Every instance, everything that's done in the real economy has a use of credit. And I've used the example of a loaf of bread. You take it from seed to the grocery store shelf, and then you could even go beyond that because people are buying food on credit now. But there's at least 10 uses of credit to create that one loaf of bread. And if any of those credit uses gets disrupted or it ceases, there's no loaf of bread.
Yeah.
Let me make one more comment. In the 1930s, we had the Depression that was created, if you will, or kicked off from the financial markets.
The setup we're moving into is unlike any silver cycle that has come before it. The alignment of India with BRICS, the growing recognition of silver as a strategic reserve, and the mounting stress within global credit markets all point toward a structural repricing of tangible assets. Once silver clears the psychological wall near $50, the entire paper framework could unravel, exposing just how thin the supply truly is when real delivery is demanded. This isn't just about market speculation. It's a reflection of a deeper monetary reset already unfolding beneath the surface. As credit tightens and confidence fades, the bid for tangible value will intensify. Gold and silver will not just appreciate, they'll redefine what safety means in a system built on leverage. Those who position early will not only preserve purchasing power, but also stand on the right side of a generational shift. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.